Most people think markets move because of news. That is kindergarten. Markets move because large pools of money are forced to choose where they can hide, where they can earn, and where they can survive when the story changes by the hour. I have spent enough of my life around capital to know one thing. The public usually hears the explosion first. The institutions see the routing map first. They do not ask, "Was the headline dramatic?" They ask, "Where does the money go if this holds, and where does it go if this breaks?" That is the game. And if you miss that, you will spend your life reacting to noise while other people quietly position for the next flow of capital. I want to talk to you about a report that should offend you a little, not because banks make reports, they always have. Not because institutions talk to institutions, that has always happened too. What should offend you is how many ordinary investors are taught to stare at the fire while the biggest players are already mapping the exits, the shelters, the rebound trades, and the panic trades, when a ceasefire appeared in the Middle East. A lot of people looked at it like a morality play. Peace or no peace, relief or no relief, good or bad. I looked at it the way I have looked at almost every serious market event in my life. I looked at it like a switchboard. One switch changes, and billions of dollars start rerouting. That is the mother line of this whole story. If you understand the switchboard, you stop acting like prey. If you do not understand it, you become somebody else's liquidity. Most investors are trapped in what I call the headline trap. They think the headline is the event. It is not. The headline is just the bell that rings before the money moves. By the time the public says, "What does this mean?" the better prepared money is already asking a different question. Which sectors were abandoned too hard? Which sectors are crowded too hard? Which scenario gets funded first? Which names rebound if fear fades? Which names become shelters if fear deepens? That is why a ceasefire headline matters less than the capital map underneath it. I have seen this mistake over and over. People think war means buy whatever just went vertical. People think fear means sell whatever just fell. People think one scary week cancels the earnings power of a good business. People think one hopeful week repairs a broken balance sheet. That is not investing. That is emotional outsourcing. The market is a routing machine, and money is always looking for the next lane. Once you see that, a lot of what looks mysterious becomes embarrassingly obvious. Let me tell you what the switchboard was really showing. On one side sat a bullish script. The ceasefire holds, or at least the market believes it will hold long enough to exhale. Oil cools down, the dollar softens. Fear that had been pressing down on risk assets starts to loosen. Earnings season arrives, especially in technology, and companies that were treated like damaged goods suddenly look like survivors with real cash flow again. Hedge funds that had cut leverage too far begin adding it back. Retail investors who sold into fear start chasing the rebound capital that sat parked in safe corners rotates back into growth. Cyclicals and parts of the market that were punished hardest during the panic. That is not magic, that is routing. On the other side sat a bearish script. The ceasefire breaks. Missiles resume. Regional infrastructure risk rises. Saudi production comes under deeper threat, or shipping routes look vulnerable again. Oil spikes back toward levels that function like an extra tax on the world. The dollar strengthens because fear likes a throne. Broad stocks sell off, airlines get hit, consumer names get hit. A lot of the market gets repriced. Lower energy, defense, fertilizers, pipelines, storage, and related pockets become the places capital runs to because they are either direct beneficiaries or relative shelters in that scenario. That is not prophecy either. That is routing. The market does not need certainty to move. It only needs enough conviction to start relocating money. This is where the public gets lost. They want one answer. They want to know if everything is bullish or everything is bearish. Markets do not work that way. A market under stress becomes more selective, not less. It starts asking which cash flows improve under this script, which cash flows get delayed, which balance sheets get more fragile, which assets have already been crowded beyond reason, which ones are being sold because people are scared. Not because the business is broken. That is why I want you to stop thinking like a spectator and start thinking like a router. There are several mechanisms inside this switchboard that matter, and if you understand them, you will stop panicking every time the tape gets loud. The first mechanism is the positioning spring. A market can become so one-sided in its fear that the next move higher does not require wonderful news. It only requires less bad news than people had priced in. That is one of the great lessons in markets. Price does not move on truth alone. It moves on the gap between expectation and reality. If institutions are heavily bearish, if retail has been dumping stocks day after day, If sectors like technology have been beaten down because people suddenly decided to question AI, question earnings, question growth, question every expensive asset on the board, then you do not need paradise to create a rebound. You only need the apocalypse to be postponed. That is a powerful idea. A lot of fortunes are made not because the world becomes perfect, but because the world becomes slightly less awful than people had feared. I have watched this happen again and again. People tell themselves they are being prudent. In reality, they are often just late. They sell after fear has already done the damage, then they wait for emotional permission to come back in, which means they buy only after prices have recovered enough to feel safe again. Safety is expensive. The second mechanism is what I call the leverage snapback. Most people hear the word hedge fund and their eyes glaze over. That is a mistake. You do not need to admire them to understand their effect. A heavily levered investor can move a lot of stock when confidence rises. If funds have spent weeks or months reducing exposure, cutting borrowed risk, shrinking bets, and pulling in their horns, then a turn in narrative can create a violent reversal. Why? Because people who reduced risk now need to rebuild it, and when big pools of money start rebuilding risk at the same time, the move does not look polite. It looks like a scramble. That is especially true in sectors with real earnings power and enough liquidity to absorb large flows. Technology fits that description. So do some cyclicals. So do parts of financials when macro stress eases. Once the switchboard flips toward relief, leverage is not just fuel, it is forced fuel. That is why some rebounds feel irrational to the public. They are not irrational, they are under-owned sectors, meeting returning leverage. The third mechanism is the crowd penalty. Whenever fear erupts, the public runs toward whatever looks obvious. Sometimes that is energy, sometimes that is gold, sometimes that is defense, sometimes it is cash. The problem is not that these areas cannot work. The problem is that by the time a trade looks emotionally obvious, it is often mathematically crowded. A crowded trade carries its own tax. You pay for comfort with a worse entry price. You pay for certainty with lower upside. You pay for joining the consensus with the risk that the consensus was already fully expressed in price. This is one reason I have always preferred to buy understandable businesses when fear is indiscriminate rather than chase the loudest winner in a panic week. If everyone already knows where the safe trade is, part of the reward is already gone. Sometimes all of it is gone. Now that does not mean you never buy an energy company in an oil shock. It does not mean you never buy a defense name in a defense scare. It means you ask a better question. Am I being paid enough for arriving this late? Most people never ask that. They ask only one thing. Is this what everybody is buying? That is how you become exit liquidity. The fourth mechanism is the earnings reset. A lot of investors talk as though price is reality. It is not. Price is an argument. Earnings are where the argument eventually has to answer if a sector has been knocked down because people got frightened. But the underlying businesses still have durable demand, still have margins, still have balance sheet strength, still have products. The world is clearly not abandoning. Then a good earnings season can hit like a hammer. Technology sits right in the center of that. What I see in moments like this is a familiar human weakness. People suddenly act as though a real technology trend became fake. Because there was a geopolitical scare, they start talking as though AI stopped mattering because energy routes became unstable for a week. Nonsense. If anything, large platform companies with scale, capital, compute, and embedded demand tend to get stronger when weaker hands are shaken out. That is why fear around a durable trend can be such a gift. If the trend is fake, leave it alone. If the trend is real and the cash flows are real, panic can hand you a better price than patience usually allows. The fifth mechanism is the dollar gate. A stronger dollar is not just a currency story. It is a stress signal. In certain market scripts, a rising dollar behaves like a tighter gate. It pressures risk appetite, complicates global conditions, and tends to accompany capital running toward perceived safety. In the opposite script, if geopolitical tension cools and the dollar eases, other trades get air again. Precious metals can catch a bid under one path. Under another path, they can wobble if fear rots more directly into the dollar itself. That is why I never like simplistic rules such as bad news means buy gold or war means buy oil. It is never that clean. You must ask which gate capital is using. Is it running to the dollar first? Is it running to supply-constrained commodities? Is it running back into growth because relief lowers the discount rate on the future? Is it running into small caps because they were left for dead? Money chooses lanes. Your job is to observe the lane change before you narrate your feelings about it. The sixth mechanism is the retail echo. Individual investors love to imagine they are powerless. They are not powerless. They are just usually late and uncoordinated. When retail sentiment gets ugly enough, when selling becomes habitual, when people start using every bounce as a chance to run away rather than every drop as a chance to inspect value, they create the conditions for their own regret. If the market stabilizes, they do not come back methodically. They come back emotionally. They chase what they just sold. They buy after the move that they could have owned at a discount. That wave matters. You could call it stupidity. I prefer not to. I call it pain memory. People do not buy what is cheap. They buy what has stopped hurting them. That is why relief rallies can travel farther than the fundamentals alone would seem to justify. First, institutions reposition, then leverage expands, then retail follows. That is the echo. If you are early enough, the echo pays you. If you are late enough, the echo traps you. Now, let me make this practical because a story without a protocol is just entertainment. When I evaluate a market like this, I do not ask whether I can predict every missile, every announcement, every diplomatic insult, every overnight leak. That would be foolish. I ask whether I can build a two-path operating system and behave rationally inside it. That is how you protect your capital from your own emotions. My first rule is simple. Never build your portfolio on one geopolitical headline. A lot of people want the market to become a courtroom. They want one ruling. Ceasefire good, conflict bad. Buy this, sell that. Real markets are messier. Headlines are revised, treaties wobble, permanent becomes temporary in 48 hours. You do not need perfect certainty. You need scenario discipline. My second rule is to separate crowded panic beneficiaries from discounted cash flow machines. If energy or defense or any obvious shelter has already run hard, I want to know how much of the fear I am paying for up front. If quality tech, financials, selected cyclicals, or small caps have been hit because people panic broadly, I want to know whether price now offers me a margin of safety against a script that is merely less bad. That distinction is everything. Do not buy what feels safe. Buy what is mispriced relative to the script you think is most likely. My third rule is to respect positioning more than narrative. Narrative is what people say. Positioning is what they have already done. If investors are already leaning hard one way, the next move is often powered by unwinding, not by revelation. A heavily bearish market can rise violently on modestly better conditions. A heavily bullish market can collapse on minor disappointment. I do not care what the television says if the positioning is stretched. Stretched positioning is one of the few gifts markets hand to disciplined investors. My fourth rule is to own a watch list before the crisis gets theatrical. This is where most people fail. They wait until fear appears, then they begin research. Backward. When fear appears, I want my list ready. I want to know which businesses I would be thrilled to own if they fell another 10%, another 15%, another 20%. I want to know which sectors I would only touch if the crowded trade unwinds. I want to know which names are real businesses and which are story stocks dressed in expensive clothing. Preparation is what turns volatility from stress into inventory. My fifth rule is to buy in layers, not in fantasies. If I like a quality business and it becomes cheaper because the market is frightened, I do not need to act like a hero and call the exact bottom. I can buy some if fear deepens and the business remains intact. I can buy more. Layering is how rational people deal with uncertain timing. The obsession with perfect entries is usually just vanity wearing a spreadsheet. My sixth rule is to keep dry powder when the switchboard gets unstable. That does not mean hiding from life. It means preserving optionality if everyone around you is fully committed, fully leveraged, fully emotional. Then a little liquidity is a strategic asset. It lets you act while other people negotiate with their own fear. My seventh rule is to remember that markets overpay drama and underpay endurance. This is where so many people lose the plot. A war scare, a ceasefire rumor, a banknote, a nasty week in the NASDAQ, a hot oil print, a falling airline stock, a sudden bounce in small caps, all of it feels enormous when you live inside the minute tape. But wealth is usually built by owning streams of future cash flow through periods when other people temporarily lose their nerve. Not always. But usually, that is why I keep coming back to the same simple question. What will still matter after the shouting stops? Will semiconductors still matter? Will software still matter? Will cloud infrastructure still matter? Will payment networks still matter? Will insurance, selected banks, home improvement, consumer staples, and the larger machinery of ordinary commerce still matter? Then do not confuse a routing shock with a permanent impairment. The market confuses those two all the time. That is why opportunity exists. There's another part of this that matters, and it is more psychological than financial. Most people have never built an identity that can survive uncertainty. They need the crowd to nod before they act. They need a headline to validate them. They need the market to feel calm before they can buy. That identity is fatal if you want extraordinary results. You must become the sort of investor who can operate while the room is unsettled. Not reckless, not arrogant, not blind. Strategic. That is the identity flip. You are not a headline addict anymore. You are a capital allocator with a routing framework. You are not asking the market to make you comfortable. You are asking whether price is compensating you for the discomfort. That is a much richer question. I learned a long time ago that the market does not reward people for being entertained by complexity. It rewards people for staying rational when complexity makes others emotional. A report from a large bank can be useful. A market intelligence note can be useful. Scenario thinking can be useful. But if you turn any of those things into a substitute for your own operating system, you are still dependent. I do not want dependency. I want clarity. Here is the blueprint I would hand to any serious investor facing this sort of market. First, write down the 2 or 3 dominant scripts that can actually drive capital over the next 90 days. Do not write 10. Write the few that matter. In this case, a durable ceasefire script, a failed ceasefire script, and perhaps a muddy middle script where nothing resolves cleanly. Second, assign likely winners, likely victims, and likely mispricings to each script. That means sectors, yes, but also quality names whose earnings and balance sheet strength can survive volatility. Third, mark what is already crowded. If everyone in the world suddenly loves the same safe trade, ask what you are really being offered after the move. Fourth, define your buy zones in advance, at what valuation or price decline, or cash flow multiple, or yield. Do you want to begin? Fifth, keep staggered entries, no all-in fantasies, no all-out tantrums. Sixth, review your reasons after every major headline without changing your principles every day. A routing machine changes lanes, but it does not force you to become hysterical. Seventh, never let borrowed conviction replace earned conviction. Just because an institution likes a sector does not mean you understand the risk. Do your own arithmetic. If you cannot explain the case in plain English, you do not own insight. You own imitation. And imitation is fragile. Now let me tell you what I think the great danger is right here. It is not that investors will miss every opportunity. It is that they will misunderstand where the real asymmetry sits. A lot of people will think the whole game is to predict whether the ceasefire holds. I do not think that is the real game. The real game is to recognize that when positioning, leverage, sentiment, and earnings all get pulled apart by fear, a temporary easing of stress can produce a move much larger than the average person thinks possible. At the same time, if stress re-accelerates, the pockets of the market that benefit are not mysterious either. They are usually the same obvious shelters the crowd runs to. The question is not whether either script exists. The question is whether you can distinguish a crowded shelter from a discounted engine. That is the whole art of it. And that is where most people fail. They either freeze because there are too many possibilities, or they oversimplify because complexity makes them tired. I do neither. I build maps. And when the map changes, I do not argue with reality. I reroute capital. That is what I want you to remember. The next time a dramatic headline flashes across your screen and every talking head tries to sell you certainty, do not ask, how do I feel about this? Ask, where is the money going if this holds? Where is it going if this breaks? Which lane is crowded? Which lane is neglected? Which cash flows are real? Which prices already assume too much fear? Those questions will make you richer than political opinion ever will. In markets, the public usually arrives at the scene of the accident and stares. The disciplined investor arrives with a tow truck, a flashlight, and a price list. Be that person, because the biggest money is never paid to the man who panicked fastest. It is paid to the man who understood the switchboard before the crowd understood the smoke.